Good morning, everybody, and welcome to this month's IFRS and Corporate Reporting webinar. Now, this month we're looking at common disclosure mistakes, which I think is really timely because many entities are busy finalizing their financial statements for publication and for lodgement with the ASX and ASIC. The good news is, as you would see on screen, Kevin is back from his annual leave. He's looking well rested and refreshed. So welcome back, Kevin. It's lovely to have you back.
Thanks, Aletta. It's good to see you all again. And thanks for holding down the fort while I've been away.
No, that's great. We're just happy that you had a good time and a good trip. And now we can push till Christmas. Kevin, I did hear on Monday on the radio, they said on Monday it was 100 days to Christmas. And I thought, can you just stop, right? Don't even tell us that. You know, that just gives you a panic attack to think everything we have to do before Christmas. But the countdown is on. We would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. As always, I'm on the land of the Wurundjeri people of the Kulin Nation here in Melbourne, and we extend that respect to Aboriginal and Torres Strait Islander peoples here today. As you know, we've been running for many, many years. I think it's the 8th year now, monthly IFRS and corporate reporting webinars. After today's webinar, we've got 3 left for the year, some big ones. In October, we look at share-based payments. In November, it's our update for 31 December. And then in December, just before Christmas, we look at a brand new accounting standard, IFRS 18, presentation and disclosure in financial statements. And it's replacing the current IAS 1, which is a fairly old standard. And then for the last 4 years, we've been running sustainability webinars. Next week, Kevin and I will be looking at a focus on processes and policies to manage climate-related risks. And we'll also look in October at climate-related metrics. In November, we talk at setting climate-related targets. And then in December, we're looking at climate-related disclosures in Australia.
Aletta,
and I'll flag.
Interrupt
Sorry,
you.
Kevin.
Just quickly, I'm not seeing the slides moving, so I just might bring that to your attention if there's something on your side.
Yeah, that is a very good point.
It's a great message.
Let me just. Can you see it now, Kevin?
There we go. Well done. Absolutely. That's great.
Okay, thank you, Kevin. And everybody would receive the slides. But what I wanted to say is, so we've got our sustainability webinars, and I might flag already that we're working on a tool, an online tool that will go on our website to help with climate-related disclosures. So that will be launched within one of these webinars. We just had another planning meeting this morning. Also, Kevin and I have been running carbon accounting masterclasses in May, and backed by popular demand. So in November and December, we'll run another series of carbon accounting masterclasses across the country. And there will also be a virtual one. So I thought I'll flag that if you want to register. Last time it was a sellout on all locations, so please get in early. Then before we get into common disclosure mistakes, I thought I should talk about the latest sustainability developments because there's been some big ones. So on Monday, the 9th of September, the House of Representatives approved the climate reporting legislation. It's been an interesting one because the House of Representatives approved the legislation months ago. Then it went to Senate, and Senate debated it for a long time, and only on the 22nd of August did Senate make one change around scenarios and scenario analysis. And because Senate made a change before they approved the legislation had to go back to the House of Representatives to approve that change. Now, all of that has happened by Monday last week. So we now have the final approved legislation approved by both houses of Parliament, and Royal Assent is expected soon. So Royal Assent is when the Governor-General provides the Royal Assent. So it's expected within this week or maybe next week. So the climate reporting timeline that we've ended up with is for Group 1 entities. It is years beginning on or after 1 January 2025. But for Group 2 entities, it's years beginning on or after 1 July 2026. And Group 3 entities, years beginning on or after 1 July 2027. I also want to flag that there's a link here to an article we've written, which includes frequently asked questions, includes some decision trees, and it's been updated with all the latest information. Just a reminder that who will be required to do climate-related reporting or mandatory climate-related reporting in the annual report. There are 3 groups, Group 1, 2, and 3. You have to consider the size of the entity. You have to consider some NGER aspects and whether the entity is an asset owner. Now, this particular table, which was originally published by Treasury, and we've repeated it, and you can see the source there at the bottom. It was from the policy position statement. We thought it could be a bit confusing, and we received a lot of questions about this table. So we've converted it into a decision tree. And as you know, I just love a decision tree, especially if there's some color in it. So you can see the threshold question is the entity lodging financial reports with ASIC as required by Part 2M of the Corporations Act? And we've got a reference there to Section 292 capital A. If you say no to that, you're not lodging financial reports with ASIC, then you don't have to do any mandatory reporting in this sustainability report in your annual report. So that's the red block. So that's a threshold question. If you've said yes to that, you have to do mandatory reporting. Then the question is just whether you are Group 1, the green block, Group 2, the blue block, or Group 3, the yellow block. And we've tried to put in a decision tree to build in all the considerations. So the first one is whether you're an asset owner. So that is the entity a registered scheme, a registrable superannuation entity, or a retail corporate collective investment vehicle? And we've got a reference in there as well. If you say yes to that, does the entity have more than 5 billion assets under management? And if you say yes to that, it means you are Group 2. However, if you said I'm not a registered scheme, etc., then we look at the size thresholds, which could get you into Group 1. Or if you don't meet those size thresholds, we consider whether you're an NGER reporter that meets the publication threshold in the NGER Act, and it's 50 tons of carbon dioxide equivalent. If you meet that, you're still Group 1. If you don't meet that, let's look at the size threshold for Group 2 entities. If you meet that, you're Group 2. If you don't meet that, let's think whether you're an NGER reporter. And if not, let's see if you're a size 3 threshold. If you're not, you don't have a mandatory requirement. So this decision tree has taken us a bit of time, very comprehensive, and it's important that every entity in your group should go through this decision tree to assess whether they are Group 1, Group 2, Group 3. And in our article, we explain this quite a bit more. I really think this decision tree is very useful. We've used it for many clients to just make sure we know which group we're in. Then in this table, we've updated the impact or when the mandatory reporting is starting. So you'll see if you've got a 31 December year end and you're a Group 1 entity, we're talking 31 December 2025. However, if you're a Group 2 entity, it's 2 years later, 31 December 2027, and a Group 3 entity, 31 December 2028, which is quite different to if you're a 30 June year end. So for Group 1 entities, it will start 30 June 2026, and then a year later, not 2 years later, only a year later, 30 June 2027 for Group 2 entities and another year later for Group 3 entities. And this is because the starting dates are a bit staggered, around 1 January 2025 and then 1 July 2026 and 1 July 2027. So just wanted to make it very clear when Group 1, Group 2, Group 3 will be subject to mandatory sustainability reporting. I also want to just remind you, what does this mean? And this has been a conversation for us. If you look at your annual report, you will now mandatorily have to report your annual financial report, your annual sustainability report. And that's the name in the Corporations Act. It's a sustainability report, mandatory sustainability report in the annual report, a director's report, and an auditor's report. But then you can see your sustainability report will initially only comply with IFRS S2 or the Australian version AASB S2. So it will only be around climate. So many clients have asked us, but what about all those other sustainability topics that we are currently including in our voluntary sustainability report? So it's important here. The mandatory sustainability report, which is only climate, will go in the annual report. And all the other disclosures around diversity, equity, inclusion, around cybersecurity, around employee engagement, all of those other will have to go in a separate report outside the annual report. And the question is, what would we call it? We can't also call it a sustainability report because the sustainability report is mandated by the Corps Act to be in the annual report and to deal with climate. So we've been thinking, BDO Australia, that we will call our current sustainability report in future a supplementary sustainability report. So it's supplementary to the mandatory sustainability report in our annual report. So all the other things will be in a supplementary sustainability report. Some entities might want to call it a voluntary sustainability report. And there are some entities that might want to put everything into the sustainability report in the annual report. Just remember, that would then also mean that you'll need assurance over that whole report in the annual report. So, you know, we have to think a little bit about naming. That sustainability report, the mandatory one in the annual report, will have to comply with the Australian version of IFRS S2. Apparently, the AASB will issue AASB S2, which is highly aligned to IFRS S2, as soon as the legislation receives royal assent, so this week or next week. And we've seen a draft of AASB S2, and we can confirm it's highly aligned to IFRS S2. And I think next month's webinar, we can look at some of the small differences. So we're expecting there to be 4 pillars of disclosures around governance, strategy, risk management, and metrics and targets. And I've given you some information of subsections, and we're working on a tool that will be on our website to assess you, to help you assess some kind of gap analysis, or what are the missing pieces and what could a roadmap look like. So if you're a Group 1 entity and you want to think, how do I get ready for 30 June 2026? We've talked about this many times. From a compliance perspective, 2 streams around carbon footprint measurement and climate-related disclosure. The strategic stream, the outcome of the strategic stream will sit in a supplementary sustainability report outside the annual report. The top 2 streams will result in information to be disclosed in the mandatory sustainability report within the annual report. We also have a roadmap for Group 2 entities with a 30 June year end, Group 3 entities with a 30 June year end. So if you want us to help you with a roadmap, please reach out to us. We would love to do that. So that's just an update on sustainability. As soon as we see that the final AASB S2 is published, or that royal assent is being provided to the legislation, we'll post it on LinkedIn. So please follow Kevin and I on LinkedIn. please follow BDO Australia. These days, the fastest way to get their message out. So to come back to today's agenda, we'll be looking at common disclosure mistakes. And to be fair, because Kevin is well rested after his holiday, he's volunteered to look at this section of the webinar today. So Kevin, I'll hand over to you.
Thank you, Aletta. And it is good to hear that the sustainability reporting is taking shape. I mean, it has taken shape for some time already at BDO, but it's obviously moving ahead quite quickly now. And 1 January 25 is really not that long away. In fact, I'm planning lunches with certain clients in April next year, which is 4 months after the effective date. So things are really happening quickly. But I guess the purpose of today is to actually just turn our attention to, shall I say, the IFRS and corporate reporting in Australia, the traditional reporting, shall we say, your annual financial statements and your annual reports that you currently have and that you're generating. And the way we've structured it today is we've really just thrown at you some of the findings that our IFRS team have picked up as part of this most recent reporting period, common mistakes we found across the financials that we've seen out in the market, or maybe some of the ones we've seen that have come through some of our audit teams, just things have popped up which maybe just required highlighting. And the way we've done it is to just compile them in a series of, you know, things to pay attention to. You can probably use this a little bit like a checklist if you want, if you're preparing your financials, because obviously the reporting season isn't over yet. So this is almost like a little bit of a, we're halfway through. These are some things to take note of. And so we'll go through those today and just kind of point them out. Some of them are listed entity focused. So things like earnings per share and segment reporting may not necessarily apply to everybody. And that might be true for remuneration reporting, but it's all relevant at the end of the day to financial reporting and the quality of financial reporting in Australia. So going through the agenda today, we're going to look at consolidated entity disclosure. I don't want to say that's a common mistake. I want to say it's a new thing that we seem to be getting wrong really quickly, so maybe it is a common mistake. We'll look at some directors report and remuneration report, and then some quick fire things we spotted in the presentation, just more generally of financial statements. Some of it's IFRS or AASB, some of it's actually Corporations Act, and some of it's just quality of information, I guess, which you might want to take away. So let's get into it in terms of having a look at this. The one thing we have left out today is actually looking at the OFR, and the reason for that is because Aletta did a wonderful webinar last month in August when I was lounging on a beach in Malaysia. So we won't repeat that, but I'll just kind of highlight that I actually think in many ways that this is one of ASIC's like focus areas. You can get into IFRS and disclosure and all the things that are required under the disclosure frameworks, but at the end of the day, ASIC in particular, and more broadly financial statements, we're driving towards quality information for investors. And a lot of that is driven by what ends up in your OFR, your operating and financial review, which is sort of focused on listeds, but it is a lesson more broadly for all corporations. So revising the 5 sections that Aletta would have touched on last month was overview of the regulatory standard, preparation of the OFR, and then things like commenting on operations and financial positions, and then business strategies and prospects, and then narration and analysis. And the business strategies and prospects is where all the good stuff, I like to say, sits, because that's where you talk about things like, well, what are you going to do? What does the future look like? What do the prospects look like? And then that's where you talk about business risks and the risks that might prevent you achieving those strategies and prospects. And that is where climate risk starts to feed in, which leads very nicely into the climate statement that's the subject of the mandatory sustainability reporting. So this does not exist external to the mandatory sustainability reporting that Aletta spoke. In fact, ASIC's seen the connection, and the connection really does come into what is the risks and opportunities from all business risks and climate. How does that feed into your OFR? And they really are pulling up entities on this. But anyhow, not going to focus on that today. If OFR is your thing, and if you missed the August webinar, there's a link there for you to go and get some guidance on it. But it is absolutely one of the common disclosure mistakes that we find, the quality around that information. So we just wanted to put that out there. So let's then get into the consolidated entity disclosure statement, and I'll start this section with a little bit of a story. When this first came out, I had this thing in my head of, aren't we already disclosing this information already? And what the Consolidated Entity Disclosure Statement is all about, it's a Corporations Act requirement, or an Australian corporations requirement, not necessarily an IFRS requirement or AASB requirement, but under accounting standards more broadly, we already disclose the lists of all our associates, joint ventures, subsidiaries. So I was like, this information's all there already. What's the problem? Well, was I in for a surprise when this became implemented? Because what the Consolidated Entity Disclosure Statement is, it's part of a broader global tax agenda to essentially rein in, movement of tax and profits around the world. And it was really designed to ensure that entities that are parents are presenting information about the subsidiaries and other related entities in their consolidated entity group in a way that is transparent about what type of relationship do you have, what's your percentage holding, and then more broadly, the location of incorporation of the entity as well as their tax residency. And it was those last two that is obviously the aim of the game, because it's trying to present transparent information about where do you conduct your business, where is that located or incorporated, and then more broadly, where's the tax residency of those entities. So it's really just expanding the traditional information of, let's say, your subsidiaries in your group. What it uncovered along the way was something phenomenal, because it turns out that entities weren't even getting the original disclosures right, not only adding these additional disclosures on. So for example, it turns out that a lot of entities were leaving out immaterial subsidiaries in their disclosures. So they weren't actually even disclosing all their subsidiaries before. They were making a decision on, oh, this subsidiary is immaterial, so therefore I'm not even going to disclose the existence of the subsidiary. That was one of the things we've discovered along the way. And the other thing is that I've noticed along the way with this journey is the number of entities that don't really have a clue, or at least a very vague understanding of what their percentage holding is in their subsidiary. It turned out that it wasn't always clear to the parent just how much they held in these subsidiaries. So is it 60% or 80% or 100%, or is it voting interest versus equity interest? That is a bit vague in the accounting system. So this consolidated disclosure has actually uncovered that entities need to be a little bit more focused in understanding, first of all, the entities in their group and making sure they've got the systems and processes around that to not only identify which entities are in their consolidated entity group, but also the information in terms of accuracy and completeness about where is it incorporated, what's the percentage equity shareholding, and then things like which countries or locations are they incorporated in and what's their tax residency. So there's quite a bit of work here for some entities. It wasn't an easy exercise. Now, let's say you haven't jumped to the next slide. There we go. There's the next slide. So I've probably covered some of these points already. Things like the parent entity must include the list of entities in its consolidated entity disclosure statement. That is true even if the parent is not producing consolidated financials. That can happen, for example, if some of the consolidation financial statement exemptions in the IFRS 10 are activated. Doesn't mean the entity is still not a parent. They may just not prepare consolidated financial statements as a parent, but they still have to make the disclosures. This is a corporations or Australian corporate disclosure requirement. Still have to make the disclosures. All subsidiaries must be there, not only material ones. I don't know how you assess material subsidiaries in your list of subsidiaries. And then things like tax residency. You need to disclose tax residency and location of incorporation. The yellow orangey block, the basis of preparation, this is actually quite important as well, because how do you determine tax residency? So the basis of preparation on how you've actually made judgment calls about things like location of incorporation, and tax residency, you actually need to put a note in when there's judgments and how you've gone about that. So for example, we're looking for an accounting policy note really in terms of how you've prepared this note to be accompanied by this disclosure. And a good example of that is if you've got entities incorporated around the world and they've all got different tax residency, what framework or basis have you used to assess their tax residency? Is it Australia tax legislation? Is it the tax legislation in the location of incorporation? Is it some global tax literature or summary on how residency and tax amounts flow? So these are all important disclosures. And the common disclosure mistake that's occurred in this is that entities haven't paid enough attention to this, and they're still getting this information wrong. So please be on the lookout for this one. It's a good one to put on your list. As I said, this is a requirement. Probably wasn't clear at the beginning that this applies to public companies, so let's just be clear that it's not exactly all entities. It actually applies to Australian public companies. Got a link there to it, and it's all public companies that are essentially governed by financial reporting under the Corporations Act. So even some companies limited by guarantee would be caught by this if they are reporting under the Corporations Act 2M. The Chapter 2M of the Corporations Act is becoming really important in terms of the future of financial reporting, Aletta, because that's the chapter that's capturing consolidated entity disclosure. It's the chapter that captures IFRS, IFRS financial statements and annual reports, and it's also the chapter that captures the mandatory climate statement under the new mandatory sustainability reporting. So brushing up on Chapter 2M is probably the way to go if you're developing systems and processes back at your companies. I think I probably said enough about that. We can jump on to the next one, Aletta. So, director's report. Look, the director's report, which includes things like the OFR and other disclosures, is always a traditional hunting ground for how to get it wrong. I think some of the common areas we've discussed here is the OFR, as I've said, and the potential impact of climate risk and other business risks on prospects and strategies. We already discussed those. The other thing that we kind of spotted is really the disclosures around directives, and I'll probably spend a bit of time on that one. That's the one on the far right of this slide. One of the key disclosures that became obvious, especially in the listed entity environment, was the information around directors and their listed entity directorships, and the requirement in the Corporations Act to actually disclose that information for all directorships in the listed environment for the period of 3 years before the current period. That one, it turned out, was actually quite poorly addressed by a lot of companies, and so it's one we've noted for drawing out in this webinar today. I think that also speaks to the governance around data and governance around information and assessment of directors' roles and responsibilities and their skills matrix. If you don't know what other entities they are a director of in the last 3 years, it probably speaks a little bit to your own governance in terms of data, as also in terms of skills matrix, and also just understanding who are these people and where else are they involved. Are there any conflicts of interest? Are they or have they been directors on other entities that maybe are present a conflict of interest to the one they might be on? So it is telling that if the information is hard to come by or hard to make a disclosure, it does speak volumes in terms of broader governance around directors and people on directors. So that's one I'll kind of pull out and just kind of bring to your attention. It was poorly addressed in the last audit season or the last reporting season, so something to put on your agenda. I'm not going to spend too much more time here other than to say that we've got a few links there to some thought leadership and other areas where you might want to focus. And the TCFD framework is still, as far as I can tell, maybe Aletta, you can tell me if I got this one wrong, I think it is still ASIC's recommended stepping stone towards mandatory reporting. There's a reason for that. I mean, ASIC realizes, just like Aletta and I and BDO recognize, that in order to get to the end game of mandatory reporting, you need to go through a roadmap, and Aletta's already pulled those roadmaps up, and you'll notice on the roadmap we've incorporated TCFD framework in there as a stepping stone. Why have we done that? Because it takes the entity forward with a framework to actually start gathering the disclosures around the impact of climate, let's say in the OFR, so that it builds up to the mandatory sustainability reporting when the new legislation becomes effective. So I'll just kind of highlight that it actually is something to think about if you're preparing this information and you're looking at this director's report. have a look at the TCFD as an activation strategy. We've got the 11 recommendations of the TCFD framework there, and there's even an activation checklist which you can download from the video website, which can help you on your journey. And it all speaks to the quality of the common disclosures we've seen in directors' reports. I think I'll leave it at that. To move on to the remuneration report. The remuneration report I love. I have a love-hate relationship with the remuneration report, and I think a lot of organizations do too. And the first concept with the remuneration report is realizing what it is and what information it's trying to communicate. It's obvious remunerations on key management personnel, but it's actually more than that. It's meant to be a report that essentially documents not only what the remuneration is, but the strategy behind it. And this is really important because a lot of the qualitative information goes missing along the way because we all think it's about numbers and, you know, share option schemes and so forth. But what it's really intended to do is essentially draw a link between the entity, its strategies and prospects, an incentive framework, if you will, but the why behind why the remuneration and how that is linked to, let's say, key management personnel. So that we've noticed in a quality review of remuneration reports out in the market is actually our key finding here. Some of the examples we found, some of them are really interesting. I'll just kind of go left to right, top to bottom, is remuneration reports stating that they have a remuneration committee when actually one doesn't exist in the background, a huge governance flag. The other one that's come up is performance conditions. This is often around share-based payments, but really any performance condition that leads to a short-term incentive or a long-term incentive. The requirements of the remuneration report in terms of Corporation Act regulation and in terms of the Corporation Act Section 300C is not only to describe the condition itself, but to actually give an explanation of why that condition exists. Now, that's really hard to do because that's articulating in a narrative form or qualitative or quantitative form exactly what that performance condition was intended to achieve, the why, the link to the prospects, the link to the incentive, and then not only the condition itself, but how and when, and the when is important, it will be measured. And this is things like EBITDA or share price, evaluating the condition at a particular date. Why was that date selected? What is the date? And how does that link to prospects and strategies? This was sort of one of the key qualitative disclosures that I noticed in this period. Other little things are things like a number of entities have recorded members' votes against them at the annual general meeting in the previous years, and there is a requirement to actually address that in the subsequent remuneration report, including the actions or inactions in the response. And this is a little bit like, shall we call it remuneration hushing, like green hushing. Entities are quick to get on the bandwagon about what actions they've taken to actually address the vote against them in the previous year, but there's not a lot of disclosure when there's actually been inaction, and it turns out that that happens a lot as well. So it's something that needs to be improved on. And then the two blue box are consultants. This is one that actually has come as a galloping shock to a number of organizations. A lot of organizations are using consultants, remuneration experts, to essentially make recommendations on remuneration structures. This speaks to the why do we have the remuneration report, how does it link to the prospects of the organization, and how is it evaluated. And it is a requirement to actually make disclosures about the use of consultants or remuneration consultants. This is to ensure that their recommendations, if there's been reliance placed on consultants in formulating remuneration strategies, that they're free of bias. So there's things like disclosing the name of the consultant is important, and a whole bunch of other requirements. So not only is it important to actually reference the use of consultants in setting these policies, it's also, as in the second block there, important to reference when they've been used to evaluate things like benchmarks against performance conditions and so forth. I think one of the other ones that we picked up at, in one of the reviews was actually just making reference to a consultant when one wasn't even used at all. So this is really just similar to the first one about if you've got a committee but it doesn't actually exist, you really should be making those disclosures. And I'll touch on two last ones. Yeah. Second last one that I want to deal with is not including or inconsistent inclusion of details of former KPIs. This is once again drawing back to the disclosures around directors and their former directorships. It's essentially governance around information. And when directors step on and step off, and the dates they step on or the dates they step off, information around that often seems to go a bit missing, and it seems to drop off in comparative disclosures. We seem to become a bit vague about who our former directors were. All of that information has to be retained, updated, maintained, and continued to be disclosed over a period, including comparatives. And like I said earlier in the presentation, when it comes to directorships on other listed companies, actually disclosing those relationships for the previous 3 years to the current financial year. So there's a lot of information around that needs to be retained and just maintained in the financials. And then finally, my favorite one, and this is an easy one that I'm going to deal with today, and that's not including annual leave and long service leave allocations for KMPs in your disclosures. And this often happens by mistake, mostly because of the way the accounting systems are set up. A lot of organizations will try and reconcile their KMP information to their note in the financials, and that gets tied to maybe a general ledger line items in the general ledger system. But what ends up happening is the leave and the long service allocations of those KMPs often isn't captured in the payroll general ledger code. They're captured in different line items, sometimes around the general ledger, and entities tend to forget that lying in the long service leave provision account is an allocation that belongs to the KMP, and that needs to make itself into the remuneration report. What often ends up happening is the cash payments get picked up and maybe the share-based payments, but all the on-costs that go with it are sitting in other general ledger accounts for the KMPs, and they don't get picked up into the remuneration report. And that's a quick one to spot when you're doing a disclosure review of financials, because things don't always tie up nicely into the body of the financials, and it's understanding how they don't tie up and maybe even disclosing how it can be reconciled to the financials. That's really good disclosure. So I'll jump off on that one and kind of move on to some of the other practical presentation issues. These ones are going to kind of fire through a bit more quicker. These are just things that we've spotted along the way, and I actually had to go back and remind myself about the first one, which is rounding in financials. Aletta, I actually had to pull out the legislative instrument to prepare for this one, because I couldn't believe it was actually in the presentation. How could we possibly get the rounding wrong? But I think what's actually happened over time is organizations have perhaps they've started to grow, the numbers are getting bigger, so they're moving into different categories in terms of their size. And there are rules about the rounding conventions relative to size that need to be maintained. And I think that's really what's happened over time, is that things have started to slip. So just a reminder then about this legislative instrument. There is an instrument about rounding. You need to disclose, if you're a financials, the choices you've made in applying the legislative instrument, both in the director's report and in the financial statements. Very important. Is you should apply the rounding factors based on your current period assets, and I think this is where it's gone a little bit wrong. The current period assets are starting to move. Entities are jumping into different categories, so they lost sight of the rounding conventions, and then they've kept the exceptions to the rounding conventions are starting to become inconsistent. So I'll show you what those are in a couple of slides. You are required to have a rounding note even when rounding is to the closest dollar. That is important. And the financial statements should show the cents if the entity chooses not to apply the legislative instrument. So there's rules about actually how you apply cents if you're not rounding, because you're not applying the rounding convention, then you're choosing to disclose cents. So you need to remember that. I mean, inconsistency, this is probably the reason why it's been raised, is because using the same rounding factor in the financials and the director's report is important, unless other rounding conventions and factors are prescribed, as I'll point out now, but also just being consistent with your current period asset. That's really important. And then the last one there is to remember that the legislative instruments do have force of law. So non-compliance with this is in fact a breach, and also something the auditors will have to evaluate. So I'll kind of do a quick sprint through these. The way this has been outlined, and this is Aletta says she loves the decision tree, but she actually also loves a table. So you know, I'll give that to her. And the way the legislative instrument is laid out does not look like this at all. If you've ever tried to read the legislative instrument, you probably need a legal degree to kind of wade through it. So I think that's another reason why it probably gets dumped a bit. But the way it's structured is essentially to create ranges based on asset size at the consolidated balance sheet level, remembering this is done in the current period, and then prescribing the rounding for most items being to the nearest dollar, thousands, hundred thousands, or millions. And what tends to happen is you start to fall out of those ranges or move up to a different range, and suddenly your rounding convention goes out. But what you'll see in the blue boxes is that for specific items, you have to maintain your rounding convention. And in some cases, like earnings per share, it never changes. So the earnings per share is always to 1/10 of a cent. And we start to see things go out of whack, especially as the rounding moves up into those different categories. You can see with the director's report there's really only two roundings, which is to the nearest dollar to the nearest thousands, and that doesn't change as the other rounding changes as the asset items increase. And the next couple of slides, there's a couple of exceptions to this which you need to be aware of. Things like share-based payments. Share-based payments have got their own exception or their own specificity to the nearest dollar when you're dealing with expense and liability line items, or thousands as you move up in terms of the asset number. But in terms of things like the number of cents, like exercise price on options, those are to the nearest cent. So you can see there how it maintains it. I actually like these tables. I'm not really sure I've ever seen them in this format before. So I think another great sell from BDO is to kind of pull this together. And then the last one there, I think, Aletta, is just things on remuneration for auditors, compensation for KMPs, and related party transactions. This one always gets everybody because the remuneration for the auditors is often a note in the middle of the second or third last page of the financial statement, and suddenly you notice that the rounding or the amount is to the nearest dollar for, let's say, those two first categories, whereas the rest of the financials might be to the nearest thousand. So you just got to keep track of that and make sure your columns and your headings are clear that you're rounding to the nearest convention. I think I'll leave it at that. I think I've probably blown everybody away with that. In terms of rounding, when you're not complying with Corps Act, yes, you can apply rounding, but then you are under the AASB or IFRS standards in terms of the rules there. So just bearing in mind which legislative interest you're under. Right, let's whip through some primary statements. We've got 15 minutes left, so I'm going to deal with, shall I say, the ones that I think are the common mistakes. So there's a lot on here, but we'll whip through some of it. So this is kind of just taking a step back at primary statements. So what we're talking now is statement of income and expense and other comprehensive income, balance sheet and cash flow statements. Those are, shall we call them up, sorry, and statement of change in equity, our primary statements. And maybe one day, Aletta, our climate statement will be a primary statement too. Things that we've spotted, and these are quick checks you can do which don't make sense on an initial review of your financials, which may make you prick up as to what's going on here. And the classic one with revenue is to claim that you either don't have revenue or that IFRS 15 doesn't apply, being the standard on customer contracts and revenue recognition, but then having trade receivables in your balance sheet. Little things like that. If you have trade receivables, then you're selling something. So then where's your revenue and your revenue disclosure? Share-based payment expense is something that gets lost, and this comes back to the KMP and the remuneration report disclosure. So even if you're not a listed and you're not doing a REM report, the same concepts actually apply in the body of the financials. Reconciling share-based payment expenses and recognizing it actually is an employee benefit and making sure those disclosures go together. Sometimes you find the share-based payment expense buried in other, and then it's not part of the employee benefit expense, but really it's an employee benefit expense. So what's going on there? Why is that missing? And then a myriad of disclosures either are not there or they're done incorrectly. And sometimes the rounding is even out. And then things like hybrid presentation of expenses. This is one that has raised its head for some time now. Things like doing a cost of sales presentation, so you're actually applying a by function presentation, but then it's not really clear after that what expenses should be part of cost of sales. And so you often find expenses buried further down in the financial statements that really actually are part of the cost of sales number, so your margin is wrong. There actually are I want to say there's rules and principles around that, and in many ways they spread all over the accounting standards. So I think that might be a reason why this becomes a problem. Things like selling and distribution expenses and things like depreciation and rent, sometimes those are actually absorbed into inventory measure, which means they get absorbed into cost of sales, but you often find them somewhere else in the body of the income statement or profit and loss statement, which means your margin is wrong. So you might just want to kind of have a look at that. And then just things like splitting out OCI and profit when it comes to your non-controlling interest. And I think on the last slide, we have a conversation about liquidity-based presentation in the income in the balance sheet. Most organizations will present non-current assets and current assets and liabilities, but bearing in mind there is a liquidity presentation option in the standard, and that's particularly relevant to financial institutions and banks and fintech, where their assets and their balance sheet items are essentially ordered by their ability to be liquidated or to be made into cash and cash equivalents. So those are some of the things to look out for in terms of balance sheet and income statement. I think we've got a slide next on cash flow statement, Aletta. This one I could spend a whole day on. I think the cash flow statement is the most underappreciated standard out there. I think it gets done last it gets done last before publication by the last person standing, and sometimes they don't necessarily appreciate what the cash flow statement is trying to achieve. The one in the middle is the classic example. An entity converts its convertible notes into equity. So the liability becomes equity during the year. It's clearly a non-cash transaction, but somehow in the cash flow statement, you'll see that the loan got paid off and shares were issued. So no cash move, but the cash flow statement represented as a cash movement. Those sort of logical tests in the cash flow statement are a red flag to regulators and auditors that something is amiss in the cash flow statement. And then also just, incorrectly defining your cash and cash equivalents. This is going to become more and more important as IFRS 18 or AASB 18 becomes effective in a few years' time, because cash and cash equivalent is actually clearly defined in the standard. It's cash on hand, demand deposits, and short-term, highly liquid investments that are readily convertible to cash, which don't have a significant change in value. That's quite a mouthful. There's lots of guidance around it, but what we sometimes see is that the cash and cash equivalents only reconciles to the bank account or one bank account, even though all the investments have been missed out. So that can be a red flag as well. And then foreign exchange has become really interesting. There's actually a process in the accounting standards on how you take the foreign bank accounts and foreign operations and translate them into cash flows. It's actually quite a convoluted process, because each foreign operation, for example, needs to go through its translation process, and it's normally a 3 or 4 step process before getting added into, let's say, the group or the consolidated cash flows. If you don't do it that way, there's some wildly out of sync translation differences, and then you have this balancing figure which nobody knows what to do with in the cash flow statement. That can be a red flag that you've missed the boat on presenting the cash flow movements when it comes to foreign operations. So just make sure if you've got foreign operations in the material that you're actually following the process, the steps, and that you are essentially applying the translation to each foreign operation and bank account before it gets aggregated into the cash flow statement. And then I think I'll leave it at that on cash flows, just some of the things to point out. And then the statements of changes in equity. Look, this is all about aggregation and correctly labeling things. I think the biggest thing here is when previous balances don't tie up to the closing balance of the previous year. And I'm not talking about $1 out or $1,000 out. Sometimes they're completely out and nobody knows why. So it's just making sure that the adjustments and movements and the reconciliations of all the various columns are actually tied up, reconciled, and actually clearly labeled. The use of the word other, such as other reserves and other income statement items, is going to be closely regulated when the new standard on IFRS 18 comes out, which is the new presentation standard. And the reason for that is to try and overcome the problem we've had in the past, where organizations disclose all the important things like cash flow cost of sales and employee benefits, and then they have other income at the bottom, and the other income or expense number is 5 times bigger than anything else on the balance sheet or income statement, but nobody knows what's in other. So it's trying to avoid those sort of idiosyncrasies coming through in financial statements. All right. How are we doing, Aletta?
I
On
think
track.
we're doing well, up to earnings per share. Well done.
Right. Earnings per share. Also, earnings per share, just like cash flow statement, I think sometimes is the victim of being left to the end. And so trying to kind of wrap your head around what the earnings per share is trying to achieve, and the diluted earnings per share in particular. And I think sometimes earnings per share and diluted earnings per share is the poor cousin of non-financial disclosures, especially in listed environment. You know, organizations will be keen to talk about the EBITDA or the adjusted EBITDA or some type of normalized EBITDA. But the earnings per share and the diluted earnings per share are actually really important disclosures under the IFRS statement. They often get buried at the bottom of some of the primary statements. And when you look at them, you actually notice that you haven't actually captured what's going on there. And the diluted earnings per share is really, I think personally, the big one that you actually want to focus on, because it's the one that gives the measure to the investors on just how much their diluted earnings per share, how much their earning potential from their share or from their instrument is potentially diluted by the existence of potential ordinary shares out there, like options and like treasury shares. And organizations who are doing EBITDA and adjusted and normalized profits don't always capture a diluted earnings per share in their EBITDA numbers. They don't give that indication to the investors. So the diluted earnings per share number is actually quite an important indicator of just how much is your earnings potential on your share potentially diluted by the existence of options out in the market. So it is a good measure, and it is a good measure to get right. I don't think we have a problem so much when the entity is not profitable, because when the entity is not profitable, and I've jumped to the bottom of the slide here, your basic EPS and diluted EPS are the same, because the potential ordinary shares are anti-dilutive. And a lot of organizations that aren't profitable they don't get that number wrong, because it's just a rule of thumb almost, and it's easy to get that right. But when your entity turns out to be profitable, it becomes really important then to identify the potential ordinary shares out there that can dilute the earnings per share and to reflect that. And one of the ones we've picked up in the last reporting season is things like options. So in determining your potential ordinary shares, first thing is to, in a profitable environment, the first thing is to actually determine whether they are dilutive. And they are generally dilutive when your average market price exceeds the exercise price on the potential instrument, like an option. And if that is then true, you should have a different number between basic earnings per share and diluted earnings per share. So that's the first thing to look at. But then the question is, how do you actually work out the impact of those potential dilutive earnings share? Because what's actually happening, the reason why it's dilutive is that the market price of the instrument is below the exercise price. So the amount of capital the entity is going to raise when they issue an option to convert it to a share is less than they could if they were selling it on the open market. So there's a dilutive impact. This is, you're introducing more shareholders into the mix. They're going to become benefits of the earnings capacity of the organization, but they're paying less on entry than everybody else would. So there's your dilution. And the way you do this then is to actually work out what the potential dilution is. You need to factor in the fact that those potential shares, when they become ordinary shares, that they actually do have an exercise price, and that exercise price must be factored in to determine the dilutive impact. The number of options in issue is not the number of potential dilutive shares in the diluted EPS calc. You do need to factor in the amount of capital those shares will essentially raise through their exercise price, and then essentially work out the, shall we call it, the free component, which is then taken into the dilutive calc. And that is one that our eagle-eyed audit support and advisory specialists picked up during this reporting season. What I'm really impressed with by this is that there are entities that are profitable enough for us to notice that there was an issue in dilutive earnings per share calculation. So that's good to hear, is that entities are actually, there's a bit of resilience in the market. Well, I'm going to leave earnings per share alone, because with 5 minutes to go, we'll just cover some of the other ones. Discontinued operation. This is more a factor, not so much that the presentation is incorrect, but it's mostly that discontinued operations were incorrectly identified in the first place. And this is often the case. So I think we'll just kind of run through quickly what are the requirements for identifying when an operation becomes discontinued. And Aletta, I've got them in front of me, they're not on the slides, so I'll ramble them off. Management needs to be committed to a plan to sell the operation. It needs to be available for immediate sale. There needs to be an active program to locate a buyer. The sale must be highly probable within 12 months. The asset is actively marketed for sale at a price that is reasonable in relation to fair value. And the actions that have been taken to complete the planned sale indicate that it's unlikely to be significantly changed or withdrawn. We have come across a myriad of entities that rush towards classifying an operation as a discontinued operation, often too early. And they do that because they have this idea or this bright spark that they're going to sell, let's say, a separate line of business or discontinue it or abandon it. But the standard is very clear that it's not just that you have an intention to sell or dispose or discontinue. You actually need to meet those conditions that I've mentioned, and it is surprising how hard it is to meet some of those conditions. So saying something like the asset needs to be actively marketed and be in a condition ready for sale means it actually needs to be in a condition for sale. So for example, if you have to replace the rotors on a piece of equipment before it can be sold, then it's not ready for in a condition for sale because you still have to do something to get it into a condition for sale. So this assessment isn't a high level assessment. This assessment actually goes straight down to the business. You actually want to have a look at things like, what does the marketing plan look like? Are you looking for buyers? Are you trying to sell it at a price that's reasonable to fair value? Do you have evidence to support those things? And things like, is the entity actually ready to be sold, or does something need to happen before it can be sold? If you haven't met those conditions, you haven't yet entered into discontinued operation. So I'd encourage you to have a formal, detailed assessment on those factors before rushing to, I've got a discontinued operation. And then finally, I think probably segment reporting. Parent entity disclosure. Sorry, I forgot about this one. So closed groups. This is just a disclosure we've discovered in entities that are part of a deed of cross guarantee group. So what tends to happen here is the entity in a cross guarantee arrangement, the subsidiaries don't generally have to prepare financials, but the consolidated entity at the top or the parent entity at the top has to prepare financials as well as provide details of the cross guarantees. I think the purpose of this slide is to demonstrate that in a scenario where in a closed group the parent is not producing consolidated financials, it still has to make the relevant disclosures about the consolidated closed group and the entities in the deed of cross guarantee. It's maybe a little bit of a niche issue at this point, but it is important to note that there are significant disclosures around cross guarantees and closed groups. They are not to be smarted at or sniggered at, because closed group or a deed of cross guarantee in particular is actually an instrument that has implications for all assets and entities across groups, and you need to get that information right. All right, Aletta, let's move along to our last ones. I'm not going to spend any time on accounting policies and significant judgments, other than to say, if your accounting policies on a large proprietary limited run to 30 pages, then you need to spend some time decluttering them, figuring out what's material, and also including the relevant bits of information, things like what's the significant judgments that have a material impact on my financials, not boilerplate disclosures and not repetition and not words that mean nothing or aren't entity specific. I feel like we may have gone through this a few times, and that's why I'm just going to leave these slides for this particular one for yourself to go through, because I think we've had numerous sessions along the way talking about decluttering and about focusing on the determination of material judgments and relevant judgments and material and relevant accounting policies and risks, rather than it being just a word dump that is hard to work through. All right, and then I'll jump through all those. I think I've kind of mentioned segment reporting. Segment reporting, also a topic we can spend a lot of time on. I think the message on segment reporting is not everybody has to do a segment report. That's the first thing, but it actually is relevant to everyone, because segment reporting, you still need to work out or understand what your operating segments are if you're doing impairment testing of goodwill, for example. Goodwill can't be allocated to CGUs that are higher or larger than the operating segments in an entity. So whether you're reporting segment reports or not, you need to actually still do that determination. And I think the one thing with segment reporting that often is a trigger that we've got a common disclosure deficiency is when the OFR or the director's report or the chairman's report in the financials speaks about the business differently to the segments disclosed in the financials. It's a real red flag when the segment report is talking about branches, but the chairman's report or the management reports or OFR is talking about, markets and geographical locations. The real question is, which one is it? And because segment reporting is not a disclosure requirement that is meant to exist in isolation from the way the business is run. It's actually meant to be segment disclosures through the eyes of management. What information are management receiving? Whose management? So the chief operating decision maker is the management person we're looking for. That can sometimes be the CEO, it can sometimes be the director, it can sometimes be a management committee. What are they getting for information about how the business is run, how it aggregates up, and how are they using that information to run the organization more broadly, to allocate resources? That information they are using to run the business is what the segment report disclosure is meant to reflect. What we often find is some other disclosure in the segment note, which has no bearing on the way the business is spoken about in the markets, in the investor presentations, and then you have to say to yourself, is this a red flag that perhaps we've got our segment categorizations wrong, firstly? And then it leads to things like, if you are reporting on your segments and using non-IFRS measures in the OFR and in the market and in your annual report, they then need to translate into the segment report, because once again, how is management running the business through the eyes of management? So segment report can't exist separately from the way management are looking at the information and needs to be run accordingly. All right, Aletta, I think I'll leave it at that. I think I've had a rant enough about segment reporting. It's time to bring this to the end. On the tax note, look, the tax note is, I actually want to say that myself and Kate Posey did a session on tax and deferred tax. I want to say it was early in the year. Hopefully it wasn't last year, but I think, Aletta, it might have been May or April. Can't quite remember. So we covered some of these, but the big issue with tax note and tax note disclosure is essentially being able to reconcile everything back, being able to reconcile it back to your operating profit, being able to split it into current and non-current assets, not only in the balance sheet, but also through to the other statement of other comprehensive income, to essentially do a formal judgment assessment around unrecognized DTAs and quantifying those. And essentially also having a clear understanding of how your deferred taxes related to joint venture subsidiaries and associates can be isolated and reconciled. The one in the middle at the bottom is the basis of unrecognized deferred tax, how they can be utilized. This is really important. Deferred tax assets, and especially if they're unrecognized, is really one of the key cornerstones of business prospects. If you haven't recognized deferred tax assets on how you're going to use your future unutilized tax losses, for example, being able to describe how they can be utilized and linking that back to business risk and prospects is really important. And so it's really just actually treating this more than just a disclosure checklist, but actually linking this to the treasury function, the tax function, and drawing it all together in terms of prospects and risks. With that, I would say you've probably heard enough from me on common disclosure techniques. And Aletta, I'll leave it up to you to finalize the webinar.
So Kevin, I've got some exciting news to finish the webinar. The Governor General has announced this morning that royal assent was provided to the climate legislation yesterday. So it's been confirmed, it's a thing. So it's been passed through both houses of Parliament, royal assent yesterday, and now we really have to get cracking, right? For 31 December year ends, we're looking 31 December 2025, and 30 June year ends 30 June 2026. So I just saw that, while you were talking, I was alerted to that, so I thought I'll just share it to everybody on the webinar. So it's hot off the press. But thank you very much for that, Kevin. If you're looking for IFRS corporate reporting assistance, please reach out to any of our partners. There's a broad team, and I should call out that Kate Posey, Kerry Ann Ross, Julie Paku, Alison Wolf, and Cheryl have put together the slides that Kevin used today, because they do a lot of reviews of financial statements. So thank you to the ladies for putting all of that together. You can subscribe for our regular insights. I know it's going out today, as well as education and learning via our Learning Hub. And if you're looking for sustainability assistance, as you know, we look at carbon accounting, we look at sustainability reporting and strategy, and our audit partners look at sustainability assurance, and there's a bit of a description of what all of that is. So for carbon accounting, please reach out to Kevin or I. For sustainability reporting, again, Kevin and I, or Brett looks at voluntary reporting. Strategy, we've got a few contacts, and then sustainability assurance, our key partners in all the offices. Kevin, thank you very much for the webinar. Thank you, everybody, for joining us. Hope you can join us next week when we do our sustainability webinar. It's becoming very important, so it might be time to do both series of webinars. Hope you enjoy the rest of the day. Thank you. Thanks, Kevin.
Bye. Bye, Aletta.
Okay. It's done.